we're looking together here at the Chapter 15 PowerPoint information, and we're going to start back with equity-based compensation. So what is that? So it's basically when you want to pay employees, you want to keep your key employees in particular with you. And not always, but sometimes it's because you may not have a lot of cash. So you want to come up with something that you can still give them incentive to stay with you. Or it may be just the fact that, you want something to add to their overall compensation package. You may want to give them a reason to want to stick around as well. So there's many reasons that you might do equity-based compensation. It mentions here corporate employers may compensate key employees with equity. So that could be either in the form of restricted stock or stock options. And equity-based compensation requires no cash outlay by the corporate employer. So as I mentioned there, sometimes you will see employers use this in years where their cash flow is restricted, but they still want to keep their key people in place. Right, and they may even want to try to do something to help encourage them to help the company get in a better position because it's going to help them in the amount of compensation they end up receiving. So the recipient employees become investors in that corporate business. So then keep going on with that. They mentioned the idea of restricted stock. So this is stock issued to an employee as compensation, typically is subject to restrictions on the employee's rights of ownership. So for instance, the employee may be prohibited from selling or otherwise disposing of stock for a specified period of time, right? Because you want to make sure they're going to stay around with you. And the employee may be required to forfeit stock back to the corporation if the employee terminates employment within that specific time period. Right, so same thing, just a different way of wording it, in my opinion. So they want to do something to try to make sure you're going to stay with them a while. And with this restricted stock, right, you get an option to buy it, and hopefully you're going to work hard for the company, get the current market price to increase. So when you exercise your options, then you're going to actually have some income. So it benefits you, but it benefits the company by helping their overall stock price. So what is the tax treatment to the employee? So the employee includes the fair market value of the restricted stock in gross income at the time the stock either becomes transferable or is no longer subject to substantial risk of forfeiture. So whichever occurs first. The employee's tax basis in stock equals the amount of gross income recognized. The employee may elect to include stock's fair market value and gross income in the year of receipt. So some of this is going to make more sense when we go about working some numbers to them. But just keep in mind, there's sometimes, I guess it's the balancing act. There's going to be some cases where you have to recognize a certain amount of income up front, but know that that's going to be offset because that becomes your basis and basically selling the stock later. And then other times, maybe you don't have to recognize it immediately, but then later on, you're going to have less basis to offset any gain when you sell the stock. And again, that's going to make a little more sense, at least when we look at some numbers. So they mentioned the stock options, right? A stock option is the right to buy stock in the future for a set price. And it's going to only last for a limited time. So the option price usually is less than or equal to the market price because you need to have one to buy it. Right? So if you could go and buy the stock for the same price on the market, why would you exercise an option? Right? Even worse, right, is if you could go buy it on the market for less than what you could pay for the option. You would not exercise your option in that case. Right? So the option says, okay, we had this agreement, now we've reached this certain point in time, and you can buy this at a price usually that's less than what the market price is. Is it guaranteed to be? No. But that's the hope there. And there's an opportunity for the employee to buy the employer stock in the future at a bargain price. Right? That's what I'm saying. So hopefully it's going to spell out some good parameters for us. So the employee doesn't recognize income in the year the option is granted. So there's some key terms here. So one key term or key time is when the option is granted. And as you notice, it says employees do not recognize income in the year the option is granted. Employee recognizes ordinary income in the year the option is exercised. Right, so the grant year and exercise year could be the same, but it doesn't have to be, and often is not. It mentions the income equals the excess of the fair market value of the stock over the option price. So again, we'll look at that in numbers a little bit better. And the taxable excess is referred to as the bargain element. So your employee's basis in the purchased stock is going to be your cost plus any kind of recognized income, as I mentioned. So if you do have to recognize stuff up front, you at least get to add it to your basis. Well, how is it treated on the other side of it? So the corporate employer that compensates employees with the restricted stock or the stock options, they're going to be allowed a tax deduction equal to the amount of gross income recognized by the recipient employee. So again, they may or may not be immediate. And the deduction is allowed for corporations' taxable year in which employees' taxable year of recognition ends. Right, so again, timing is going to be something we'll look at. And there's going to be a couple of different scenarios we'll look at. Under GAAP, the treatment of the equity-based compensation is different than for tax treatment. So this is going to be one of those cases where you have a book-to-tax difference. The fair market value of restricted stock is a cost that is amortized as compensation expense over the restriction period. The estimated fair market value of stock option is compensation expense in the year of grant, right? So one's amortized, one you get to expense in the year of grant, and differences between tax and book treatment result in that temporary difference between corporate taxable income and that financial statement income or GAAP income or book income is what we usually call it. And then here they just mention the idea of an incentive stock option. So no compensation income to employee on the exercise of an incentive stock option. So this is a certain kind of stock option. The employee's basis in the stock is the cost. Its untaxed bargain element is going to be part of that AMT preference item. So one of those cases where alternative minimum tax comes into play. And on the other side, it's kind of the balancing. No compensation for the employee, no employer deduction for the bargain element. And again, we're going to look at some numbers to see how they kind of all fit together, but that's kind of the general idea. If the one's going to be recognizing as income, that's justification for a deduction on the other side, and vice versa.